While there are many combinations of moving averages, there's really none that are more popular than the Golden Cross. And it does not happen frequently, and there's only been about 16 S&P 500 Golden Crosses in the history of the index prior to the one in 2016. And when it does occur, the financial media outlets, they always stress how important it is to the market, while investment firms take note of it. So what's a Golden Cross? Well, a Golden Cross is made up of two simple moving averages, a 50-period SMA and the 200-period SMA. And the Golden Cross, that occurs when the faster 50 SMA crosses over to the upside of the slower 200. And the time frame that's used is a daily frame, so it's really not something a scalper would consider using. And on the left side of this chart here, the market would be considered a downtrend as the 50 SMA is trading below the 200 SMA. And the yellow circle highlights where the 50-day moving average crosses above the 200 moving average. So the Golden Cross definition can simply be when the short-term moving average, the 50 period, crosses the longer-term 200 period to the upside, a Golden Cross occurred, and we consider a bull market. Now, traders should really understand that a moving average, there's no magic to it. They're just a mathematical calculation. And the simple moving average is the easiest one to calculate. So if you look at a 3-day moving average as an example, we're just going to take the prices of the last 3 days, the closing price. We're going to add them together, and we're going to divide them by 3. So this day's price is $1.85. This day's price is $2.10. Today the price is $2.76. So the calculation is 185 plus 210 plus 276 divided by 3 equals $2.23. So on the open of the 4th day, the moving average will be plotting at 223. So the calculation for the 50-period moving average is going to take the sum of the closing prices of the past 50 days and divide by 50. The 200 period, take the sum of the closing prices of the last 200 days, divide by 200. Now the 50 and the 200, they're nothing special, except we're looking at a short-term trend compared to a long-term trend. You can use different combinations that are close to these numbers, and you should see virtually the same results. So using the Golden Cross as part of a technical analysis approach, it appears to make sense. After all, the talking heads, they like to refer to it, and we are using a well-known technical indicator. So does the Golden Cross have any predictive power? Do stocks engage in powerful bull trends after the cross? Do all liquid markets react positively to the trading event? Charles Schwab, it's a popular financial firm, and their chief investment strategist, her name is Liz Saunders, reported to their clients that performance following a Golden Cross was no better than the performance over any random time period. So let's take a look at crude oil. And I've plotted the Golden Crosses that have occurred since 2013. And what's important to note is that the bullish moves that would be expected never materialized. Any long position on the daily chart that retraced soon after the cross, that would have your trade in drawdowns. Now, interesting to note that the cousin of the Golden Cross, the Death Cross, it's a bear market signal, outperformed the Golden Cross on this particular chart. So while traders flock to the Golden Cross indicator and others to decipher the market, ensure that you understand that they may or may not offer you a trading edge. So is there a Golden Cross strategy that makes any sense? All right, let's repeat. A Golden Cross occurs when the 50-day moving average crosses the long-term moving average, the 200-day. So what does it mean? All we're seeing is a shorter-term calculated average increase faster than the longer-term average, and there's no edge in that. And one of the main issues when using moving averages as your buy and sell signals, it's the problem of whipsaw. And whipsaw occurs when price action does not have a sustained direction, and it swings back and forth. And so will the moving averages as they cross. So what can we do if we're convinced that we need to use this cross in our trading? Well, we can use it for the higher time frame trend determination. A Golden Cross is generally talked about in relation to the stock market, so let's take a look at an individual stock. This is Apple, and it had a nice 116% increase in price since the cross occurred in 2016. And if your exit is using the Death Cross, you lost 35% of your gains, and for many traders, this is unacceptable. But we can use the uptrend that's confirmed by the cross and only take buy orders on the lower time frame. This is multiple time frame trading. And in my opinion, it's one of the better ways to use the cross. Now this chart here is the 4-hour chart of Apple. And remember, we're in an uptrend on the daily that was using the golden cross as our trend confirmation. So we're going to trade the cross with range trading and standard technical pullback trading strategy. So at number 1, the cross occurred on this time frame, showing that this smaller time frame trend is heading up. We see momentum move, and then we see basing at highs. This is a price action pattern that you can trade. Number 2, it's a standard pullback trade. Number 3, we have a pullback trade that has a gap. Number 4, basing at highs of momentum, and that's a price action trading pattern leading generally to highs. Number 5, we have 2 simple pullbacks, although many traders would probably sit out the second one due to the lack of follow through of the first one. And number 6, now this is a pullback, but good pullbacks to trade have a corrective decline that lacks momentum. Now, this does not. Number 7, gap and a thrust down is a pullback that you're going to ignore if you're looking for long off pullbacks. And the black line shows where the daily chart had a death cross and we would stop trading the stock. Well, you need a stop loss to protect the downside, and for that, a multiple of the average true range is a pretty good one to use. So since the golden cross is a trend following strategy, you may wish to wait until the death cross occurs as your exit. Well, as seen above, you may give back a large percentage of your gains when you do that. Still, it is a pretty simple way to manage your trade, as you're going to spend very little time in doing so. And many traders, really, they could use more time away from their positions in order not to micromanage them. All right, so let's wrap this up. A golden cross bullish signal is when the 50-day crosses to the upside over the 200-day. Trading moving average crosses can result in a string of losses due to the whipsaw effect of price. Minimal time is spent managing the trade, as your exit is the reverse cross, the death cross, if that's what you choose. And using the golden cross as a multiple time frame trend tool plus the use of standard price patterns, I think is a better way to trade with it. Anyway, so I hope you enjoyed this. And remember that being a risk manager is your first priority. So you remember that when you're testing any trading strategy.